Hello, this is Chris McKeffey of BX Partners, and I'm here today with Cornell Bowden on your left and Greg Bowden on your right of Sheetsmith Investment Management. We're here to talk today about the absolute return balanced SMA strategy that is run by Sheetsmith. It's available to you in both UMA and CES and resides within the U.S. multi-asset category. It can best be described as a tactical investment management strategy. So Cornell, how do you define tactical investment management, and then how do you at Sheetsmith execute tactical?
Whether an investor knows it or not, there are only two types of asset allocation: static and dynamic. Tactical asset management dynamically changes the portfolio mix for changes in market and economic conditions to meet a particular goal. That goal for us is to find the optimal asset allocation that will help preserve capital and reduce volatility first, and to make competitive long-term returns for the client. Now, how we do that is we compare the relative value of stocks, bonds, and cash on an ongoing basis, and also on a risk-adjusted basis, and we reallocate capital from overvalued assets to under-manner.
Thanks, Cornell. So, Greg, this strategy, you've run the strategy for a long period of time. Who would you say are the best clients for your strategy specifically, and where does it fit into their overall investment strategy?
So the ideal investor would be anyone who is more interested in reducing volatility and avoiding significant losses than those being willing to ride the full roller coaster of the market in an effort to maximize their potential returns. We strive to avoid significant losses so that we have more dry powder during the recovery phases. To that end, since the inception in 1999, our strategy has produced cumulative gross returns comparable to that of the S&P 500, but we've done it with more than 30% less volatility. We typically see our strategy being used in three types of methods. The first is commonly known as a core satellite strategy. This is where a financial advisor will place the majority of the client's assets with us, and will utilize smaller satellite investments to complement us. They may use things such as commodities or green energy or small caps or whatever to overweight those areas. The second methodology we see is more of a silo type of strategy, and it's used for larger AUM clients. And this is where the FA will allocate funds to an equity silo, a fixed income silo, and an alternative silo. They may even utilize multiple money managers within each of those silos. We most often fit in the alternative silo, and the FA will sometimes use us as a bellwether. When he sees us shift between the asset classes, it raises a red flag that he may need to adjust the higher level silo allocations as well. The third methodology involves smaller AUM clients where the entire account is placed with us. Our strategy offers those clients a level of asset allocation and downside protection that they normally would not receive otherwise. It's good for the client, and it reduces the FA's workload.
So, Greg, you've discussed several times the thought of reducing volatility or delivering, lower volatility versus the S&P. I mean, how do you feel is the best method to perform risk management in the markets?
So the simple answer is active allocation. An academic paper was released many years ago that showed that over 93% of the variation of one's returns relative to the market were due to the asset allocation decisions in the portfolio. So to avoid the volatility of the overall market, we believe your portfolio actually has to be different than the market. Passive investing has gained some traction in recent years, and those investors get to experience the full swings of the markets which most of our clients are trying to avoid. Other strategic asset allocation guys may have a static 60-40 mix, and those clients are always getting a combination of the best and the worst. So as Cornell mentioned earlier, we are constantly keeping track of the risk-adjusted relative value of the asset classes, and we strive to maintain the optimal mix of stocks and bonds to reduce the long-term volatility.
I think that makes sense, and I think a lot of clients would be interested in lowering their long-term volatility. So Cornell, U.S. multi-asset can mean a lot of different things to different clients, advisors, and money managers. What does it mean to you?
Well, as a whole, the U.S. multi-asset is a broad classification of strategies where managers may invest in multiple U.S.-based asset classes or styles of securities. In contrast, most managers specialize in investing in particular segments or certain areas or styles of the investment universe, such as large cap value, small cap growth, or perhaps municipal bonds. And their mandate is to stay fully invested 100% of the time. We have the luxury in down markets to raise cash. Our multi-asset style allows us to invest in any of those styles of the stock and bond markets based on where we can find the best opportunities in ever-changing markets. Our approach looks at the universe of stocks of all publicly traded companies on major exchanges in the United States, and we attempt to find the best one regardless of capitalization, industry, or economic sector. And by doing this, we in essence manage the style boxes and the sector allocations on from a bottoms-up perspective.
Thanks, Cornell. Greg, I'd like to revisit a topic with you that you brought up in your previous remarks, which is lower volatility. I think what we found over time is many strategies deliver lower volatility, but not necessarily when it's most needed. You've run this strategy over a long period of time and seen some of the very worst markets that are out there. How did you do when it really counted? Like during the 2000 to 2002, the dot-com bust, or the Great Recession in 2008, 2009, the times when that downside protection really mattered to clients.
So our strategy actually performed very well in both of those timeframes that you mentioned, and they actually were using different methodologies to do that at those times. And what I mean by that is the economic factors in the dot-com boom and bust had us move from 100% equity down to about 50-50 stocks and bonds during the dot-com boom and bust. And as everyone probably knows, the market, the S&P 500, was down nearly 44% from peak to trough. And our strategy during that time period, because we made the shift from equities to bonds, our strategy was actually only down 1.4% relative to 44%. In the financial crisis of 2008, when the correlation between stocks and bonds went to 1, we didn't move to bonds at that time like we did in 2000, but we did move to cash. And what we were able to accomplish, while the market was down nearly 51% from peak to trough, we were only down 31%. So we were able to significantly reduce the losses in both of those timeframes that you mentioned.
Thanks, Greg. So it sounds like you were able to deliver the downside protection when it was needed most. Thanks, both of you, for being on with us here today to kind of give us an overview of your strategy. For more information, for a complete presentation, please see the fact sheet or get in touch with us, and we'll get you the information that you need. Thanks, everybody.